Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Good morning, friends. Okay, so today we are starting with a new chapter which is on dividend decision. I'll first set the context of the chapter. See, till now we learnt about one financing of money, which is where the money is going to come from. It could be coming in the form of debt, equity, preference, and we had a chapter around cost of capital, capital structure, leverages. In this, whenever we raise equity, for them, the reward which we pay is called equity dividend, which fortunately or unfortunately is discretionary nature. Discretionary means company sometimes may pay dividend, sometimes may not pay dividend. In this chapter, we are going to learn how much dividends an organization should pay. Like in capital structure, we were analyzing what should be the structure 50-50, 40-60, 100-0. Should a company pay dividend? And if yes, how much should it pay? And the impact of the dividend payment ultimately on the share price of the company. Ultimately on the share price of the company or value of the company. Some models will say pay more dividend, you may have a higher value. Some model may say pay lower dividend, you may have a higher value. So end objective is very simple of this chapter is to evaluate the impact of the dividends paid, impact of the dividends paid ultimately, impact of the dividends paid ultimately on the market price per share of the company, and ultimately market price into number of equity is called market value of equity of the company. We have totally 5 models. Like we did capital structure, we had 4 theories. Here we have 5 models: Walter's model, Gordon's model, Graham and Dodd, Lindner's approach. Like capital structure at relevance model, irrelevance model. What is relevance model is change the capital structure, value will change. Irrelevance model, change the capital structure, no impact on value of firm. Similarly, here some theory, specifically your approach. There also approach said no impact. Here also approach is going to say whether you pay 1 rupee dividend or 2 rupee dividend or nil dividend, there is zero impact on the value of the company, zero impact on value of the company. And there are certain models which says no, value of the company will get impacted if you pay a higher dividend vis-a-vis a lower dividend. This is the broad start. The broad start is there are 5 models. Certain models are saying value of the company or value of the share will be impacted with the payment of dividend, and certain models are saying no, value will not be impacted with the dividends paid. In the context of that, we have the first model, which is Walter's model. Now Walter's model basically said price of a share, price of a share is combination of two things. Tell me the formula of cost of irredeemable debt. Cost of irredeemable debt. Interest after tax divided by net proceeds. So this was the formula, KD equal to interest divided by net proceeds. We also had a formula called KE. KE is equal to what? D1, ignoring the plus growth rate part, okay? Ignoring the plus growth rate. P naught is equal to D1 by KE. D1 by KE. There is a growth element which has to be brought into the formula. How we brought and all, I'll explain. P naught is equal to D1 by KE. Walter said price of a share is equal to dividend divided by cost of equity. Dividend divided by cost of equity. This is one part of the formula. Dividend divided by cost of equity. Along with that, there is an extra value for, see, I earned a dividend of, with an example also parallelly, we earned EPS is 20 rupees, EPS is 20 rupees, dividend is 5 rupees, dividend is 5 rupees, earnings is 20 rupees, earnings per share. Cost of equity, let's understand, 10%. 5 by 10%, I write in decimal to avoid rounding issues, 5 by 10%, and this side, retained earnings divided by cost of equity. What is retained earnings? Retained earnings is technically nothing but E minus D. E is the earnings per share, D is the dividend per share. So 5 by 10%, 15 by 10%, 5 by 10%, 15 by 10%. The formula is not this formula, there are some changes. If you add this together, will D and D get cancelled? Check. Will D and D get cancelled if you add this together? You'll have to tell me. Is K common for them? So mathematically D and D will get cancelled. No. See, what have we done? I did here 20 minus 5. I did here 20 minus 5. Mathematically 5 plus 20 minus 5 divided by K. The formula is not this. The formula has certain changes. So the point is, here whatever earnings we are making, we're going to split into two. Dividend and cost of equity. Dividend and the cost of equity. Dividend is 5 by 0.1. Cost of, 5 by point, dividend by cost of equity is 5 by 0.1. And whatever we have retained is 15 divided by 0.1. If this is what is going to be the formula, then there is no point in splitting. No. What is the point? It can be 515, it can be 416, it can be 1 rupee and 19 rupee. See, what you paid will come in the first part, what is unpaid will come in the second part. If the formula is going to be divided by KE, why should I do this? So here, this has a multiplier, What does the multiplier do? There are three types of companies according to the multiplier. The three types of companies are, there are good companies. That model does not use the word good and all. This is just for your understanding. Bad, neutral. Good means this, whatever we did E minus D, we multiply with something called as R by K. We multiply something called as R by K. What is R? Is ROE of the company. R is ROE of the company. What is the formula for ROE? EAES divided by amount of equity, ratio analysis. EAES divided by amount of equity. So this E minus D, which you use in the numerator, will have a multiplier called R by KE. Now, if I am a good company, R could be 25, KE could be 20. Indirectly, this value will get inflated. That R minus D minus K is 15 rupees. But when you multiply with this, it may become 18 rupees. In that top part, R by K. R, it can be that bad company. R is 20, K is 25. When you multiply 15, random number, okay? When you multiply with this, that 15 value may become 12. R by K is a multiplier. You could be a company where you are earning more than what equity shareholder want. R is what I am earning, K is what you want. You are the equity shareholder, I am the company for this chapter, okay? So I earn more than what you want. R by K will be greater than 1 technically. And in this formula, 20 minus 5 can have a multiplier, let's assume 0.15 by 0.10, 0.15 by 0.10. Mathematically, this part of the formula will become more than 15, and automatically value improvement will happen automatically. So why is this extra benefit? Because I am a good company. Good company means I am earning more than what the equity shareholder wants. So Walter said, if you are like that, you deserve little better valuation. You deserve little better valuation. Nothing for you to write. Be in listen mode only. So here I use a multiplier called R by KE. R by KE. Will keep everything in decimal only to avoid the issue. Sometimes percentages can be confusing for some students. R by KE. When you do this R by KE, this is good situation. There can be a bad situation also. Bad situation is this is 0.08. This is 0.08. And a neutral situation is both are equal. Both are equal. R by K is equal. In the calculator, can you please do 50 plus the second part 0.15 by 0.10 into 15 ultimately divided by 0.10. 0.15 by 0.10 into 15 and then ultimately divided by 0.10. What's the value you get? 225. 275 is the value. 225 and 275 is the value. Can you do the second one? 50 plus 50 plus 120, 170. Then the last one. 50 plus 150, 200. So different situation, we are getting different values. Different situation, we are getting different value. You could be a company which is doing really well. The indication for that is return on equity is greater than cost of equity. Such a company should ideally, we did this, but what they could have ideally done is leave this zero. Leave this as 0 and put everything this side as 20 minus 0. Put everything as 20 minus 0. You will get higher value. You will get higher value because R is greater than KE. Let us derive value from the second part of the formula, not the first part of the formula. I'll explain again. See, I can decide how much dividends to pay. If I am a company where R is greater than KE, don't pay any dividend. R is greater than KE, don't pay any dividend. What will happen? This will be 0, this will be 300 and we are getting the value of 300 by what? Not paying dividends. By not paying dividends. Listen, very simple. If R is greater than KE, keep this as 0. Keep this as 0. If R is less than KE, please make this as 20. Make this as 20 and make this part as 20 minus 20. Make this part as 20 minus 20. Pay full dividend. Pay full dividend. I'll repeat the logic again. Concept is very simple. What we are trying to do here is dividends has two parts. Our value has two parts. D by KE, R by KE into E minus D divided by cost of equity. As an CFO of the company, I can decide whether to have dividends or no dividend, whether to pay dividends or no dividend. As you change the dividend percentage, value will keep changing. Another example, EPS 10 rupees, R is 20%, K is 10%. First situation, I pay dividend of 1 rupee. 1 by 0.1 plus 0.2 by 0.1 into 10 minus 1 divided by 0.1. D by KE, R by KE into E minus D divided by K. This is earnings per share. In this situation, we'll get a value as 10, 180, 190. 10, 180, 190. I can change the same situation as 5 rupees dividend, 5 by 0.1 plus 0.2, 0.1, 10 minus 5 divided by 0.1 divided by 0.1. What will happen to here? 50, 50 plus this part will be 100, 150. You change again dividend, again value will change. This is called relevance model. This is first called relevance model. Change the dividend, value will change. Change the dividend, value will change. The formula is what? First part is called what? Participate. D by KE. Second part is E minus D divided by KE. Some students ask, sir, can I make common KE? Yes, you can make it. You can make it. Why do I write separately? Just to say that there are two components. But otherwise, single formula. ICAI only uses KE as the denominator. I keep it as two parts. Okay. This has a multiplier called R by. This multiplier can be more than one. If it is more than one mathematically, put everything here, don't pay any dividend. Put everything here and don't pay any dividend. If this multiplier is less than 1, don't put anything here, put everything here. Put everything here, pay full dividend. If it's equal to 1, whether you pay 1%, 10%, 20, 50, 60, doesn't matter. Doesn't matter. This is what the broad concept is. Broad concept is D by KE plus what? R by KE into E minus D divided by KE. I'll keep coming back to this. Company earns EPS of 20, ROI is 10%, cost of equity is 15%. What is the fair price under Walter's model if the company has a payout ratio of 40%? Payout ratio of 40% means dividend is 40% of the earnings per share. Dividend is 40% of the earnings per share. Now in your notebook, write example 2. Example 2. Write in your notebook. Price equal to. Example 2. Price equal to. Price equal to dividend by cost of equity R by KE into E minus D whole divided by KE. D by KE, R by KE into E minus D whole divided by cost of equity. Whole divided by cost of equity. Just a quick example to get the grip. D by KE plus R by KE into E minus D whole divided by cost of equity. How much is the earnings per share? Keep participating. Earnings per share. Payout ratio. 40% of this is how much? 8. What is the cost of equity? 15%. We normally write 0.15. Even 15% you can write, doesn't make any difference. 0.15. How much is return on equity? 0.10, 0.15 into 0.10 by 0.15 into earnings per share is how much? Dividend. Tell me the first part. 8 divided by 0.15, 2 decimal. Sorry? 53 point. Second part. Same 53.33. And we get the value. And we get the value. This is what model is all about. There are certain points more to be explained, but the model is very simple. Put together how much? 106.67. 106.67. Any doubts first on the model? Okay. Can you proceed? 53.33 plus 53.33, 106.67. Can we proceed? First is what is dividend per share? Because certain terms will have to be aware. Dividend per share is nothing but total dividends divided by number of share. If they give EPS and payout ratio, multiply both. If they give dividend rate multiply with face value per share. Dividend rate multiply with face value per share. R is return on equity, but that's not the only name. Question may sometimes use the word IRR. They may use the word IRR, that is R only. They may use the word return on retained earnings, that is also R only. They may use the word return on investment, that is also R only. They may use rate of return, that is also R only. They may use the word return earned by the company, that is also R only. That is also R only. Return earned by the shareholders, that is KE. Return earned by the shareholders is KE. Return earned by the company is R. If they don't give the value, this is the formula. EAES divided by amount of equity. EAES divided by amount of equity. Not sure you'll remember this, but EAES, if you divide by number of equity share, you get EPS. Equity, you divide by number of equity share, you get book value per share. We have learned this in ratio analysis. Book value to market value, one formula was there, very limited usage. PVPS. So either you can apply this formula at an overall level, or you can apply the formula at a per share level depending on the data. EPS by BVPS or EAES by amount of equity. But the only point you'll have to be aware is the question can use different names. IRR, rate of return, return on retained earnings, return on investment, return earned by the company. Only thing is, if it says return earned by the shareholder, this is key. Cost of equity, investor required return, investors return, opportunity cost of capital, rate of capitalization. 100% equity company means cost of capital also cost of equity. If you are 100% equity, KO equal to KE, KO equal to KE or equity capitalization rate. Can there be any other name? I don't remember. I'm not sure, but if at all any different name come, we may add it here in the list. But this I've taken from different question. It may use the word rate of capitalization, opportunity cost of capital, equity capitalization rate. EPS we are aware. EAES by number of share. This formula you have no. ROE is equal to EPS by BVPS. Take BVPS to the other side. Take BVPS to the other side. You will get what? ROE into BVPS is equal to earnings per share. This is on the equity part. This is on the equity part, different terms. And this is what I was trying to explain earlier. Good company are greater than KE. Good company are greater than KE. See, listen, very simple. R is what company is earning. K is what a shareholder wants or what a shareholder wants to earn. If R is greater than K, I earn more. Your needs are lesser. If I earn more, entire profits I'll keep it with me. If I earn more, full profits I'll keep it with me, no dividend payment. Full profits I'll keep it. Full profits I'll keep it and pay what? Zero dividend. Pay zero dividend. Full profits with me, pay what? Zero dividend. Full profits with me, pay zero dividend. R greater than K. R less than K means I earn 8%. You want 10%. So what you are saying is, whatever profits you made, give it to us. We will invest somewhere else and earn 10% because you are not able to earn. You are not able to earn. If I earn more, full money with me. If you earn more, full money with you. If I earn more, full money with me. What is full money with me? No dividend payout. If you earn more, what is you earning more? KE is 10%. What is KE? What you want to earn or what you can earn? What you want to earn or what you can earn. If I earn more, 0%. If I earn less, 100%. Equal any amount you pay, 5%, 10, 15, 20, 25, 30, 40, doesn't matter. Both are equal, doesn't matter. Both are equal, doesn't matter. Clear? Any doubts on this? Any doubts on this point? Understood? Can we proceed? Got clarity? This is first model, okay? This is on the model called Walter's model. We have a second model, Gordon's model. Once I discuss both the model, I'll be going back to question solving, okay? So coming to Gordon's model, this is not a new formula. Not a new formula. Tell me the formula for cost of equity which we learned. D1 by P naught plus growth. There used to be minus flotation cost, but ignore that. Okay, ignore that for the time being. Flotation cost and all will not be there in many. I take G to the other side. KE minus G is equal to what? D1 by P naught. Take P naught to this side. D1 P naught is equal to D1 by KE minus G, and this formula only Gordon gave. He gave this formula, Gordon. Did he give this formula? No, he gave the cost of equity formula. He gave only the cost of equity formula, that is interchanged here. That is interchange here. P naught is equal to what? D1 divided by cost of equity minus growth rate. Same issue will come in this area also. You will not have clarity whether it is D0 or D1, whether it is D0 or D1. So D1 by P minus G, you can also call it as D0 into 1 plus G. What is 1 plus G? Is adding the growth rate on the D0 dividend. Adding the growth rate onto the D0 dividend, RR. E1 means earnings of the next year into the payout ratio is called dividend of the next year. Earnings of the formula is only one, D1 by K minus G. D1 can be calculated as D0 into 1 plus G or E1 into payout ratio, or E1 or next case E0 into 1 plus G into payout ratio. E0 into 1 plus G will become what? E1 into payout ratio. Different ways getting to D1, different ways getting to D1, getting to D1, different ways getting to D1. Clear? Any doubts in this? P naught is equal to D1 by K minus G, D0 into P naught means today's price, P0, D1, D0 into 1 plus G by K minus G, E1 into payout ratio divided by K minus G. Any doubts on this? Okay, this formula, whatever I've explained, just give me a minute. Okay, in this, I may have to little bit go back to what we did earlier. Earlier is when we did in the other chapter, cost of capital, we had a formula for G. What is the formula? I have not added it here. What is the formula for growth rate? ROE into retention ratio. ROE into retention ratio. ROE is EAES by equity. Retention can become 1 minus payout ratio. So this is one formula we learnt there. I'll be using it here in few questions. We may have forgotten it because we learnt in cost of capital chapter, not here. I've not reproduced the formula here. That was not the only thing. There was another approach to calculate the growth rate, another approach to calculate the growth rate. That approach was based on past history. Based on past history, they will give two dividends. I may be better, let me show it there itself. We learnt it here. How to compute growth rate? ROE into retention ratio based on past dividend history. Take the latest, take the last time period. Look at, if you have 2010 and 2020, 2010 is called present value, 2020 is called future value. You have 2020 and 2030, 2020 is called present value, 2030 is called future value. If you have 2030 and 2040, one is called present value, 30 is called present value, 40 is called future value. And we had this future value is equal to present value into future value factor, and present value is equal to future value into present value factor. That factor table will be given in the question. If they give you future value factor, use this formula. If they give you present value factor, use the second formula. Use the second formula. Will I be using this formula? Not much in this chapter, but still, suddenly one question I may tell that please follow the formula we learnt in cost of capital chapter. In the cost of capital chapter, we have learnt about growth rate. We have learnt about growth rate. Clear? Any doubts till this? Growth rate is equal to what? ROE into retention ratio are based on past dividend history. Any doubts on this? Clear? One small example. If a firm declared 25% dividend on share of face value of 10, growth rate is 5%, rate of capitalization 12%, price would be now, right? Example 5, P naught is equal to D1 KE minus G, KE minus G, KE minus G. How much is the face value? And what's the dividend declared? 25%. 10 into 2.5. Assuming, because I still don't get clarity, but assuming it is declared now, it is called D0. If you declare now, it is D0. Add what? Growth rate for the next year. Next year is adding the growth rate, but consistency will not be there in this part. Okay, D0 versus D1. Into what is the growth rate we have? 1 plus 0.05. What is the cost of equity? 12 minus 5. 12 minus 5. 10 into 25%. 37.5. Is that the number you're getting? 37.5. That is the last option. Okay. In case that option is not there, without adding growth, without adding the growth rate in the MCQ. Okay. Their consistency is little less. Okay. Let's do another example. Cost of capital is 12%. Cost of capital will be cost of equity if you do not have any extra data. EPS is 20 at the end of the year. End of the year means E1. Its existing payout is 25. Company wants to increase it to 50. What will be the effect on this as per the Gordon model? As per the Gordon effect means what is the change in the price? What is the payout ratio today? And you want to increase it to 50%. Let's write the basic information. KE, tell me what is the KE? 12%. EPS 20 rupees. Payout ratio 25%. R is return on equity, rate of retained earnings, return on investment. Something is given about R. Reinvestment rate is 15%. Listen, this is one situation. Same thing we will repeat other side, right? K is equal to 12%, E1 equal to 20, payout ratio we are increasing. Payout ratio we are increasing. We are increasing it to how much? R is, right, P naught equal to D1 K minus G. D1 by K minus G. D1 by cost of equity minus growth rate. Cost of equity minus growth rate. D1 is what? E1 into payout ratio. Earnings of the next year multiplied with the payout ratio. Earnings of the next year multiplied with the payout ratio. 20 into how much? Can you tell me how will I get growth rate? Growth rate we just now saw. ROE into retention ratio. ROE into retention ratio. ROE is 15%. Retention is 1 minus the payout ratio. So growth is 0.15 into 0.75. 15 into 75. 15 into 75. Any doubts on this? 0.15 into 0.75. The basic question to just get started with. How much are you getting here? 666 point. Clear? Same formula, will use it on the other side. D1 will be different, growth will be different. D1 will be different, growth will be different. D1 will be different, growth will be different. Any doubts first on this? Can I do the other side now? Other side P naught is equal to D1 KE minus G. What's the payout ratio now? Sorry, into 0.5 again into 0.5. Triple 2.22. Triple 2.22. 222.22. Impact means the difference in the values. Impact is basically the difference in the value. Price is decreasing here. Price is decreasing because of whatever changes we are making. Price is decreasing because of whatever changes we are making. Any doubts till this? Understood? Can we proceed? So it will decrease by how much? 444.45. 444.45. Any doubts on this? Understood? But in other examples, you can see that later. Any doubts on this? Can we proceed? And the fourth concept, which we have already seen in ratio analysis, ROE is equal to EAES by amount of equity. EAES by amount of equity. What does EAES divided by number of equity share called? EPS. And this, what is this? Share capital plus reserves minus fictitious asset. If you divide by number of equity share, it is called book value per share. It is called book value per share. With this, my base concepts are ready. Till I go to the next model, I'll have to keep doing questions now. Any doubts till this? I'll repeat. We learnt that dividend models are going to decide whether an organization should pay dividends or not, and the impact of the same on the share price of the company. The first model is called Walters model, which basically said price is equal to what? Dividend by cost of equity plus R by KE into E minus D divided by KE. That's all. R by KE into E minus D divided by KE. Gordon's model basically said price is equal to D1 divided by cost of equity minus growth rate. Any doubts on the concepts? Done? Clear? Okay, now I move to concept 5, Gordon's model only, but it's called step up growth. Now, where is it coming and what is it coming in this situation? Listen, when we did Gordon's model, our formula was P naught is equal to D1 by KE minus G. But there is a problem in the practical world. Growth which you see is not necessary that it has to be same number every year. The growth can be different. For example, A question says growth is 20% for first 5 years, or let me take not 20%, 10% for first 2 years, 8% for third and fourth year, and thereafter 6% till infinity. Thereafter 6% till infinity. Now I asked you apply the formula. You said P naught is equal to D1 by KE minus G. D1 okay, I will get it. KE okay will be given in the question. If I ask you G, you will give me 3 answers. 10 is also there, 8 is also there, 6 is also there. What do I write as the answer? Is it 10% or is it 8% or is it 6%? Because 3 numbers are there, and practically this is possible because it is not clear, it is not right to say that the growth will be same always. Initially, when I start any new business, first few years we may even grow 100%. Thereafter, the growth will go down to 40%, and maybe at some stage it grows down to some 10-12% till infinity, till infinity. Now, in this situation, what concept is value of any asset. You would have learned this concept. Value of any asset, present value of future cash flow discounted at investor required rate of return. This is a concept I would have told you when I did bond analysis in the cost of debt chapter. Or any asset you want to value, the concept is present value of future cash flow, present value of future cash flow. I'll show you where we have gone through this, but 100% we would have gone through this concept. Future cash flow, valuation of bond, value of any asset, present value of future cash flow, value of building, present value of rent plus sale value, value of car, present value of income from Ola plus resale value at end of life, value of irredeemable bond, present value of interest plus principal, value of irredeemable bond. So we would have done all of this at different places. So this concept is what we are going to use. What the concept says is very simple. Year cash flow, PVF, DCF, year cash flow, PVF and DCF. In order to value a building or value an equity share, please write year cash flow, some discount rate and discounted cash flow. First year it will pay dividend of 10 plus 10%. 10 plus 10%, 11. Last year was 10. Okay. Second year it will pay dividend of 11 plus 10%, 11 plus 10%, which is 12.1. Third year it will pay dividend of 12.1. What is the growth rate in the third year? Please do it in the calculator and tell me the number. Plus 8%. 13 point. I can round off also for the discussion. Let me not round off. Okay. Fourth year 13.068. 13.068 plus what rate? 8% plus 8%. How much is this? 11344. Year. Fifth year plus 6%. Sixth year plus 6%. Seventh year plus 6%. Eighth year plus 6%. Ninth year plus 6%. Like this, it will keep going on. Is there any end to an equity share? Is there any end for an equity share? No. So you cannot be writing infinity. 5th, 6th, 7th, 8th, 9th, 10th, 11th, 12th, 13th, 14th, 15th, 16th, 17th, 18th. How many years will I write? Because there's no end. In Excel, I can write 100 years also. But in your notebook, you will struggle. So you've written till 4th year, okay? Till 4th year. Why till 4th year? Because after that, it is a perpetuity. After that, it's a perpetuity. So we learned. Can you tell me the formula, Gordon formula for P naught? P naught is equal to what? Tell me the formula. D1 when I'm at the year 0. When I'm at the year 0, if I ask you growth rate, you'll say 10%, 8% and 6%. 10%, 8% and 6%. I say give me one answer. You say no, not possible. So what Gordon said is like P naught is equal to D1. You can also say P1 equal to D2 by KE minus G. P1 price of first year, dividend of second year. Price of first year. Assuming 1 year got over. Then also if I ask you growth, you will say 10, 8 and 6 because second year growth is what? 10%. Third and fourth year 8%. Thereafter it is 6%. But one good part is P4 equal to D5 divided by KE minus G. When I come to this year, assuming fourth year is over, assuming fourth year is over, after fourth year, what is the growth rate? 6%. Only one number you are giving. After fourth year, after, not after third year, after fourth year. So what they say is, you write it like this, and then phi to infinity. What is phi to infinity? Is dividends from the fifth year till the infinite years. Till the infinite years is nothing but price of year 4. Price of, see what is price of year 0? Price of today is the present value of dividend 1 to infinity. From first year till infinity. From first year till infinity is the price of year 0. Second year till infinity is price of first year. Third year till infinity is price of second year. Fourth year till infinity is price of third year. Fifth year to infinity. So first year write dividend. Second year write dividend. Third year write dividend. Fourth year write dividend. If your notebook can handle write 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 till 100 years. Not possible for you to do. So phi to infinity he said P4. Phi to infinity is called P4. Why not 1 to infinity P0? Because the problem is P0 which you apply, that formula is basically present value of growing perpetuity. If you go back to time value of money, you would have learnt a formula called present value of growing perpetuity. That formula was D1 or perpetuity amount of year 1 divided by cost minus growth rate. This is the formula I explained when I did time value of money. So ideally, if somebody says I'm doing P naught, this is not P naught. This is value of dividends from year 1 till infinity. If I write this number in an Excel sheet for 1000 years and do year cash flow PVF DCF, I'll get 305. 1000 years, but I have to write 1000 years infinity. 100 years also okay, but 100 years also not possible for you to do. Which is where this formula came. The formula came only because we cannot be writing 100 years in the notebook. Excel sheet I don't need formula. I will write the cash flow from year 1 till maybe 100 years. In Excel I'll put a formula, automatically it will drag down. Do year cash flow PVF DCF, put a total of DCF. So what he said is P4 is equal to, listen for some time, D5. What is D5 is 14.11344 into 1.06. What is 1.06? Growth after fourth year. Cost of equity, which I have not mentioned till now, let's assume it's 10%. Minus 0.6 minus 0.6. P4 is equal to what? D5 divided by KE minus G. Why not use it year 0? When I ask in year 0, you are giving me 10%, 8%, 6%. Till you give me one number, I can't follow the formula. Till you give me one number. For that, you have to play a waiting game till fourth year. You have to play a waiting till fourth year. Assume question says first 5 years 10%, next 5 years 8%, next 5 years 6%. Thereafter stability. 15 years dividend we have to write. 15 years dividend, and P15 equal to D16. P15 equal to D16. Very long calculation. P15 equal to D16 divided by K minus G. Can you tell me what is the value here? 70.2 decimal. 00. Okay, 374 then. 374. I will discount this at 10%, which is 0.909, 826, 751, 683 and 683. Year 4. Last year 4 and again year 4. 1 divided by 1.1. I don't know what is this. I don't want the multiplication value. Once you do all this, total let's assume is 300. 300 is the price. Total is 300. Then 300 is the price. What you need to do? Cash flow into PVF. This is one way of understanding. That is first year dividend, second year dividend, third year dividend, fourth year dividend, fifth year till infinity. Or you can understand first year dividend, second year dividend, third year dividend, fourth year dividend. At the end of fourth year, you are selling the share. At the end of fourth year, you are selling the share and will get 374. If you sell the share at the end of fourth year, what will you get? 374. What will you get is 374. Able to understand the concept first? Any doubts on this? I'll give you time before I come to problem. Any doubts on this? Now, this example is of no use. Let's do one problem itself. So the point is very simple. First dividend, add the growth. Second dividend, add the growth. Third dividend, add the growth. Fourth dividend, add the growth. Can I stop at fourth year? Depends when the stability happens. Some question will say first year 10%, second year 8%, third year onward 6%. First, second alone sufficient. First, second alone sufficient. Third year, what will you do? D2 into 1 plus G divided by KE minus G is P2. P2 is equal to what? D3 divided by KE minus G. D3. Till you give me single growth rate, that formula can't be used. Till you give me single growth rate. And this is the step. Compute present value of dividend. Compute dividend till growth stability. Growth stability is 4 years. Present value means year, cash flow, PVF, DCF. The total of DCF. Compute price at the beginning of the stabilization phase. Beginning of the stabilization phase. What is beginning? Year 5 is the stability. Beginning of year 5 is called end of year 4. Beginning of year 5 is called end of year 4. Discount all of this at KE and get the share price. How will you get? Year, cash flow, PVF, DCF. Year, cash flow, PVF and DCF. Year, cash flow, PVF and DCF. At CA final, this is an extremely important area. Lot tested. At your level, they may not test much, but the concept is this, okay? Year, cash flow, PVF, DCF. First year dividend, second year dividend, third year dividend, fourth year dividend, fifth, sixth, seventh, eighth, ninth, 10th, 11th, 12th. Till whichever year you want to write dividend, write it. Once stability happens, a price will also come. Last year, 2 times will come. Dividend will also come. Price will also come. Last year, be very clear, okay? If fifth year is stability, till 4 years dividend and P4. Till 4 years dividend and P4. 10th year stability, till 10 years dividend and P10. Till 10 years dividend. 10th, 11th year stability. 11th year stability. Any doubts on this? Any doubts on the concept? Understood till this? Can we proceed? First, any doubts on the concept here? Let me do a question on this and then I'll explain the concept again. Let's come to 20. A&R is a large cap multinational company listed in BSE in India with a face value of 100 per share. Company will grow at 15% for next 4 years and 5% for an indefinite period. 15% for 4 years, 5% for an indefinite period. Shareholders expect 20% return. What is the meaning of shareholders expect 20%? Participate. Cost of equity. Company paid 120 as dividend for the current financial. Paid means D0. Paid means D0. Shares are quoted at 3122. Shares are quoted at what? 3122. Find out the intrinsic. Intrinsic means we'll do the valuation. After valuation is done, shares could be overpriced in the market or underpriced in the market. See, what people do is there are a lot of equity research companies. Today, TCS share price is 2000 rupees. What will we do if you are an analyst? You will apply Walter model, Gordon model and arrive at the fair price. If my fair price is 2500, market 2000, I feel it is 2500, market 2000, let us buy that. Let us buy that because the real value is 2500. If somebody tells you this pen is available at 10 rupees, everybody will buy it because the real value of the pen is 100 rupees. Let's assume the real value is 100 and suddenly if I tell 10 rupees, everyone will come and buy this. Everyone will come and buy this. So they want us to find what is the real value of the company. After we find the real value of the company, we will compare with 3122. Now, in order to find the real value of the company, I can follow Walter's model. I can follow Gordon's model. I can follow step-up growth model. Walter not possible. Gordon directly. Step-up growth is also Gordon only. Step-up growth is also Gordon only. What is the growth rate in this question? Participate. What is the growth rate? 15% for how many years? 4 years, and thereafter. So stability happens in fifth year. Stability happens in fifth year. Stability happens in fifth year. Able to understand the question till now? Open 4 columns. Year, cash flow, PVF, DCF. Question 20. Year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Present value factor and discounted cash flow. Very simple approach. Have they given the cost of equity in the question? Is there a cost of equity in the question? How much? PVF at 20%. PVF at 20%. Year 1. Can you tell me what was the last year dividend? Sorry? How much is the growth rate for the first year? Do 120 plus 15%. 120 plus 15%. Very simple approach. 120 plus 15. How much? I'll come to PVF DCF in some time. What is the growth rate in year 2? 138 plus 15%. 158.70. 158.70. 15% growth. 15% growth. Any doubts in this? Can we proceed? Year 3, what is the growth? Till you keep telling me 15, I'll have to keep doing it. Once you say 5%, I will do perpetuity valuation plus 15%. How much is this? 182.51. You can do 505 also or 51, that's okay. 182.51. Any doubts in this? What is the growth rate for fourth year? Again 15. 15, I don't have a choice. Plus 15%. 182.51. 209.89. 209.89. Any doubts till this? Any doubts in this? What is the fifth year growth? Sixth year? Seventh year? Eighth year? Will it change after this? No. Then write P4. Pi to infinity. If it's not going to change, let's do infinity valuation. D phi divided by KE minus G. Year dividend, fourth year price. Year dividend, fourth year price. Fifth year dividend, fourth year price. Understood the calculation? Fifth year dividend, fourth year price. Fifth year dividend, fourth year price. If you tell again it will change, then let me wait till 6th, 7th, 8th, 9th, 10th, 11th, 12th. I don't know when will have stability. Last year, what was the dividend? Participate. Last year dividend 209 point. What's the growth rate now? 1 plus 0.05 divided by what is the cost of equity? Get the answer. 2 decimal answer. $1469.23. Listen, if they had said fifth year 12%, sixth year 10%, seventh year 8%, eighth year 4%, and thereafter 4 till seventh year write the dividend, 8 to infinity is price. 8 to infinity is P7. 8 to infinity is P7. In the calculator, 1 divided by 1.2. Give me the answer. 1 divided by 1.2. Discount factors and all we learned earlier. I hope you remember it. 1 divided by 1.2. How much? 833. Then 694. 579. 579. You can do 4 decimal or 3. I leave the choice to you. Okay. 579. 482. 482. 1 divided by 1.2. This we learnt in time value of money. 833, 694, 579, 482. Then what is the next one? Same 482. Same 482. Fourth year only. No. Why are you changing now? I told very clearly it is the same fourth year which will come. Same fourth year will come twice. Because that is the price at the end of year 4. That is the price at the end of. Students make a mistake of writing the next factor. You put another equal to and then do it. Same fourth year. Fourth year alone will come twice. Fifth year alone will come twice. Sixth year alone, depending on when you are calculating price. Because we have calculated, see the wording there. P4 equal to D5 by K minus G. P4 means end of year 4. End of. If you don't want to write fourth year, then write fifth year dividend. P5 D6 by K minus G. Even fifth year dividend and fifth year price you write and put a total same answer you will get. That will have some rounding of difference. I did it in the fourth year itself because after fourth year, same growth rate. Multiply the two. 138, 2 decimal answers. 114.95. 110.14. 105.67. 101.117. 708.17. And this gives me the intrinsic value, technically called as fair value. Intrinsic value, fair value of share. Put a total and let me know the number. What's the total you get? 1140.10. Printed answer can have difference in case we have done more decimals. I'll repeat again. Concept is very simple, right? Year cash flow, PVF, DCF, right? Year cash flow, PVF, DCF. Start writing from the beginning itself. No need to do any extra. I used to do 2-3 working notes separately, printed answer, but directly write year cash flow, PVF, DCF. First year dividend, second year dividend, third year dividend, fourth year dividend, fifth, sixth, seventh, eighth, ninth, 10th, till you find stability. Till you find stability. What is stability? Plus number you write. No. I'll ask you what is the plus number. You say 15. Okay, no problem. Again you said 15. No problem. Continue. 15, 15, 15. Till you say 5, I'll have to keep adding. Till you say 5, I'll have to keep adding. Moment you said 5, put a stop. P4 equal to D5 by K minus G. Because 5 was the end. If 5 is not the end, 2 is the end. Then plus 2 when you get, till that you write. Plus 2 when you get, till that you write. Any doubts on this? What is the share price today? P122, highly overpriced. This is overpriced. Why overpriced? Because my analysis says price has to be how much? 1140. Market is saying what is the price? 3122. Right? Share is overpriced in the market. Share is overpriced at P122 as compared to share price of 1140. Share price is 1140 and it is overpriced at what rate? 3122. overpriced at 3122 as compared to fair price of how much? 1140.10. 1140.10. I valued a calculator. The real value of the calculator is 1140. When I went to the shop, he said 3000 rupees. I don't want that product. I don't want that product. Such shares, we will try to sell it. If we have this, I'll sell it for 3000 rupees. If I have the share, I'll sell it for 3000. If I don't have, don't do anything. We are not going to buy this. We are not going to buy this. Any doubts on this? With this, the discussion on step up growth model, one example is over. Any doubts on this? Understood? Clear? Good morning, friends. Okay, let's continue with the discussion of dividend chapter. I'll quickly summarize what we learned yesterday. Dividend is basically the reward which we pay to the equity shareholder. And objective of this chapter is to decide what amount of dividend to be paid to the equity shareholder. Because if we pay dividend, there is some benefit, some disadvantage. Paying benefit, equity shareholder gets the money, but the company may not be able to use it for expansion purpose. Not paying, shareholders may be unhappy. We have multiple models which are going to decide that how dividend will impact the share price and ultimately the valuation of the company. In that we learned two model, Walter's model and Gordon's model. Walter basically said price is equal to, what is the formula? D by KE plus R by KE into E minus D divided by KE. D by K is the amount which is paid. R by K into E minus D is the amount which is retained and paid in future. In this we learn D represents dividend per share, which is total dividend divided by number of shares, or you can also say this to be equal to EPS into payout ratio or dividend rate into face value. Dividend rate into face value. R is return on equity, IRR, ROE, ROI, rate of return on retained earnings. Formula is EAS by amount of equity or EPS by BVPS, book value per share. Earnings per share is EAS by number of equity share, or using the ROE formula multiplied with BVPS, and KE is equal to cost of equity, investors required return, opportunity cost of capital, rate of capitalization, cost of equity capital, cost of capital, different names are there. Then we learned that in order to decide what is an optimum dividend payout ratio, we compare R with KE. We compare R with KE, and it could be a situation where that R is greater than KE. It's a growing company, don't pay any dividend. R is less than KE, then it is a declining company, pay 100% dividend. And if they are equal, it is a normal company, any amount of dividend can be paid. We are kind of indifferent on the dividend payout ratio. Then we went ahead and saw Gordon's model, where price is equal to D1 divided by KE minus G, or D0 into 1 plus G divided by KE minus G, or E1 into payout ratio divided by KE minus G. There's also a link between your EPS, BVPS and ROE. ROE is equal to EAS by amount of equity. EAS by number of equity share is called EPS. Amount of equity, which is share capital plus reserves minus fictitious asset, divided by number of shares is called book value per share. And Gordon's model also had a step up growth model, where you please write year, cash flow, PVF, DCF, right? First year dividend, second year, third year, fourth year, fifth year, sixth year, seventh year, till you find stability. Once you write all the dividend, if you have written sixth year and seventh year stability is that P6 is equal to D7 by KE minus G. Discount this at one rate and get the present value. Any doubts on this? Clear? Understood? Just give me. Okay. Now we move to the next set of concepts. 1 minute, please. Okay, next set of concepts. Concept 6 is called cum dividend and ex dividend price. We have learned this earlier also, and again we are bringing it here. Cum dividend and ex dividend price means whenever I buy any asset, the asset can be either with the income or without the income. I gave you an example that time, that assuming I want to buy this property, if I buy it on December 31, I will get the December rental income as the owner. I'll get the rental income as well the property. I'll get the rental income. So if I buy on December 31, I will pay 1 crore 1 lakh. If I buy it on January 1, I may pay only 1 crore. December 31, I pay 1 crore and 1 lakh. And January 1, if we are buying, we will pay only 1 CR. We'll pay only 1 CR. Reason is very simple. If you buy on December 31, you get the property as well as the rental income. If you buy it on January 1, you get only the property. You get only the property. So, if you get property as well as the income, that is called cum dividend value, cum interest value, cum rent value. Cum dividend or cum interest or cum rent value. Cum dividend, cum interest or cum rent value. And if you are getting it on the January 1, if you are getting it on the January 1, you will have to pay only the property value. You will have to pay only the property value. Why are we learning this? Earlier, we learnt about how do we value the share. So let's assume you do Gordon's model. P naught is equal to D1 by KE minus G. You got answer 100. This 100, in the market, they say the share is at 104, including a dividend of 6 rupees. 104, including a dividend of 6 rupees. So market is not 104. Market is at 98. Market is at 98. Why it is 98? Reason is very simple. When you buy at 104, in 2-3 days, you will get 6 rupees back. In 2-3 days or in 1 week, 6 rupees will come to you. Because you are not paying 104 for the share. You are paying only 98 for the share. And 6 rupees is to get the 6 rupee dividend income. 6 rupees is to get the 6 rupee dividend income. So if I value at 100, market says 104, you will say market is overvaluing. Whereas if you understand market is giving 98, you will say it is undervalued. You will say it is undervalued. So for comparison, we can only compare anything at X dividend value. We can compare anything at X dividend value. This is also critical for cost of capital computation or cost of equity computation. In your KE, what is the formula for KE? Tell me the formula for KE. D1 by P naught plus growth rate. That P naught which we use has to be X dividend value. That P naught which we use has to be X dividend value. I've already talked about this in cost of capital chapter. Not sure how many you will remember it, but you'll have to keep revising the concept, then only you'll get grip. What is the formula for KP, cost of preference? Preference dividend by net proceeds, and net proceeds can either be issue price minus flotation cost or current market price. If it is current market price, it has to be X dividend value. If it is current market price, it has to be X dividend value. Cost of debt, interest by net proceed. If net proceeds is CMP, CMP has to be X interest value. CMP has to be X interest value. CMP has to be X interest value. And the rule is your cum dividend value. For example, property 1 crore 1 lakh on December 31, 1 lakh rent came to me. On January 1, it will be at 1 crore. It will fall by the amount of income. It will fall by the amount of income. If at all you have done your accountancy, or when you learn in accountancy, for example, if I buy something at 105 and it includes an income of 7, journal entry for this will be bank account credit 105, but debit investment 98, income will be debited for 7. Income will be debited for 7, and in some time it will be credited for 7. In some time it will be credited also. What is credited? Bank account debit to income account. Bank account debit to pay 105, get back 7. Get back 7 in some time. So the point is, X dividend value is the real value of the security. Cum dividend value is X dividend value plus the dividend income, and the relationship is price falls by the amount of dividend. Price falls by the amount of dividend per share. Price falls by the amount of dividend per share post the share becoming ex dividend. Post the share becoming ex dividend. This is also relevant for one more scenario. What is the scenario is? Let's understand this. I have 1 lakh shares of TCS. Price today 110. Price today 110. Dividend they are giving is 10 rupees. Dividend they are giving is 10 rupees. If 110 and they are giving dividend, this includes 10 rupee dividend. This includes 10 rupee dividend. So what happens practically is price is 110. Dividend will get paid in few days. Once it is paid, price will fall to 100. Once it is paid, price will fall to what? 100. Once it is paid, price will fall to 100. How many days? We don't know. It could be few days. Price will fall to 100. I will get 10 into 1 lakh. I'll get 10 into 1 lakh, which is 10 lakh and use this 10 lakh and buy new shares. Use this 10 lakh to buy new share. When I buy new share, I will be allotted shares at 100 rupees. I'll be allotted shares at what? 100 rupees. This came as a 2-mark exam question. I'll be allotted shares at 100 rupees because dividend declared, dividend paid, share price fell, dividend reinvested at the reduced share price. Dividend reinvested at the reduced share price. Dividend reinvested at what price? At the reduced share price. For example, I am holding 1 lakh shares, currently trading at 50 per share, currently trading at 50 per share, has a policy, Mr. A has a policy to reinvest the amount of dividend into shares, HM Limited declared a dividend of how much? 10. If they declare 10 rupees, 50 will go down to 40. 50 will go down to 40 and my income will be reinvested at 40 rupees. My income will be reinvested at 40 rupees. Any doubts on this? Understood till this? Okay. Now listen. It says at 50 per share, HM Limited paid a dividend of 10. Paid. The word used is paid, not declared. Paid a dividend of 10. Paid a dividend of 10. If they use the word paid a dividend, it means this is already ex dividend. This is already ex dividend. This is already ex dividend. Paid means already paid and now you are giving me the price. Already paid and now you are giving me the price. After payment, the share price will fall down to the ex dividend value. The share price will fall down to the ex dividend value. I'll repeat again. Concept is very simple. Dividend today, January 1, you give 40 rupees or 50 rupees. January 5, paid 10 rupees. Paid 10 rupees. After January 5, if you have paid 10 rupees. If you have paid 10 rupees on which day? On January 5, share price on Jan 5 will fall to 40. Okay. I paid and I'm giving you January 5 price only. Paid and giving you January 5 price means it is already fallen. It is already fallen. This is what ICAI tested in the exam. They use the word paid a dividend. Rather than using the word declared a dividend, they use the word what? Paid a dividend. I'll show you that question. Just give me a minute. Small words ICAI plays around. Mr. A senior executive has holding of 42,000. The shares are currently traded at 480. Currently traded at 480. Mr. X has a policy of reinvesting the amount of dividend received back into the share. Declared and paid. Declared and paid. Declared and paid means this 480 is assumed to be after that fall. This 480 is assumed to be after that fall. 480 is assumed to be after that fall. 480 is assumed to be what? After the fall. Declared and paid. Declared and paid. In this case, 42,000. How much dividend are we getting? Divide by 480. Divide by 480. Divide by how much? 480. How many shares you are getting? 26. 42,000 plus 2625. 44,625. 44,625. This they tested in an exam situation where you may, because the point is, this may look like that word paid. Paid means it is already after the fall. It's already after the fall. Understood the question? Understood the difference? I have been using the word declared question. Exam they asked declared and paid. They asked declared and paid. Able to understand this difference? This is one concept where what we are doing is we are trying to find how much extra shares will be allotted to us if we do reinvestment, of our income. Read question 13 and give me the answer. It is only declared, not declared and paid. Yeah, give me the answer. 2 lakh into dividend is how much? 20 divided by 80. Divided by 80. We get how many shares? 50,000. They are saying determine number of share Mr. A would hold after reinvestment. Original 2 lakh, extra 50,000. Original 2 lakh and extra 50,000, 2 lakh 50. Any doubts on this? Understood this part? Can we proceed? I'll do questions around this in some time. Okay. But this MCQ itself is kind of sufficient. Next model we have is Graham and Dodd model. Graham and Dodd model are traditional approach. Now he said very simple. Price is equal to, like we have EPS into P multiple. He gave his own model. Price is equal to dividend plus earning by 3. No logic for earning by 3 into multiple. Multiple is not P multiple. It is some other multiple which the question has to give. Practically not followed. What he said basically, listen. Price is equal to dividend plus earning by 3. Any shareholder, according to Graham and Dodd, if I tell you that I will give you 10 rupees dividend today, or wait, let me reinvest and I'll give you 100 rupees later, people will still prefer 10 rupees only. People will still prefer 10 rupees. His logic is, let me at least get something now. You are presenting a beautiful future. I don't want any future part. Give me money today. For example, according to this model, let's assume earnings is 30 rupees. Okay. Earnings is 30 rupees, 30 by 3, and entire 30 will be added here. Entire, it's not retained earnings which is added. The formula is what? Dividend plus earning by 3. Earning is fully counted. Dividend is also fully counted. Dividend is a sub part of the earning, but both are fully counted here. So if you make 30 rupee earning and if you declare 30 rupee dividend, you will get the highest value. You will get the, because you will multiply, let's assume, into 10. If you declare 10 rupee dividend, 10 will come here. 1 rupee dividend, 1 will come here. 40 rupee dividend, 40 will come here. 50 rupee, sorry, not 40, anything less than 30. Anything less than 30, any amount you declare as dividend, that is given full value. And earning is given by 3. Why divided by 3? No logic. Okay. There's no logic. He came with his own model. He said dividend plus earning by 3. Dividend plus earning. The important part is when we did Walter's model, it was dividend plus retained earnings. Dividend by cost of equity, retained earnings by cost of equity. Here, dividend is counted fully and double counted in earnings also. Double counted in earnings as well. That's what he gave us model. Why logic and all? Let us not get into it. His model is very clear. He said what? Dividend plus what? Earning by 3. Earning by 3 into a multiplier. Earning by 3 into a multiplier. Any doubts in this model? Clear? A small example. Price is given 56. Dividend is 60%. Multiplier is 2. Formula is what? 56 is equal to dividend plus earning by 3 into 2. I don't know the dividend, but I can say dividend is 0.6 E. 0.6 E. And earning is E by 3 into 2 into 2. Able to understand this? 0.6 E plus E by 3 into 2. Please solve and tell me the E. Fifty-six, 2 will go the other side, will become 28. 1.8 E plus E by 3. E will become 30. E will become 30. This is called Graham and Dodd model. Graham and Dodd model. According to this model, 100% payout is always best. 100% payout is no R by KE, nor R equal to KE, no R greater lesser. And according to the model, pay full dividend. Pay full dividend. Right, wrong and all, we are not debating on it, but according to the model, pay full dividend. Any doubts till this? Understood? Clear? Can we proceed? Any doubts on this? Okay. Next model is called Lintner's model. We discuss this model and then just give me a minute. Yeah, then we do questions. Yeah, I'll come to now Lintner's model, concept 8. Concept 8. Let us do Lintner's model. Listen. Let us assume last year EPS 50 into 40%, DPS 20. This is last year. Now what Lintner said is there are possibilities that company may have an excellent growth. Company may have an excellent growth. This is last year. Next year EPS goes to 100. EPS goes to 100. If you follow 40%, if you follow 40%, DPS will be how much? DPS is 40. Next year after this, possible that EPS goes down from 100. See, when double happens, sustainability is not sure. When double happens, 100 we reached because of one fantastic year. Suddenly we may go down to 80. We may go down to 80. If we go down to 80, dividend will go down. According to Lintner, shareholders don't like fallen dividend. Shareholders don't like fallen dividend. So, if this goes down to 80, I still need to pay a higher dividend. So, what he said is don't pay 40 this time. Maybe this time pay only 25. How 25 number come, I'll explain later. Just pay 25, don't pay 40. Don't pay 40. If you pay 25, next time maybe you can pay 28, even if the fall happens. Even if the fall happens, I can still pay a decent dividend, and dividend should continuously slightly go up. Earnings may go up, may go down, may go up, may go down, but dividend should at least show a continuous increasing scale. Continuous increasing scale. You can relate this to our life also. For example, first year my income is 50,000. That time I was spending 20,000. Second year when my income doubles, my expense should not double. When my income doubles, my expense should not double, because if expense doubled, when income goes down, I'll find it difficult to reduce the expenses. I'll find it difficult to reduce the expenses. See, income doubled. I said income has doubled, let us spend more. If you get used to that expense, next year when income goes down, reducing the expense is difficult. Same thing, shareholder will get used to 20, 40, then their mind will think next time maybe 80, next time maybe 80. So you cannot make the shareholder mentally prepare like this. It is just playing with their mindset. This is what Lintner said. Lintner basically said, you should not increase the dividend significantly just because earnings have gone up, just because earnings have gone up. This is the broad point. Okay, broad point is this. Then what did he say? 50 you have, last year you paid 20, next year became 100 into 40%, 40. Okay, 40. This difference is called target increase in dividend per share. Target increase in dividend per share is 20 rupees. You are expecting or you are wanting to increase the dividend by how much? 20 rupees. You are wanting to increase the dividend by 20 rupees. Actually increase it only by 8 or 9 rupees. Actually increase it only by 8 or 9 rupees. How is that 8, 9 understood? We'll understand in some time. Okay. Last year 50 rupees, 40%. This year 100 rupees, 40%. I want an increase of how much? 20. Actual increase is equal to 20 into adjustment factor. Something would be given in the question. 20 into adjustment factor. You adjust yourself, and maybe adjustment factor 20%. 20% means 20 into 20%, only 4 rupees I'll increase. 20 into 20%, only how much? 4 rupees we will increase. I'll show it again. Compute last year dividend. Last year dividend, my example is 20. Compute ideal next year. Ideal next year in my example is 40. Ideal next year is 40. Needed increase 20. Actual increase 20 into 20%, 4 rupee. And next year dividend 20 plus 4, 24. 20 plus 4, 24. 20 plus 4, 24. I'll show again. Dividend of last year 10. Dividend of last year 10. Speed of adjustment. Speed of adjustment will tell how much are you going to increase the dividend. How much are you going to increase the dividend? Last year dividend 10 rupees. Adjustment 40%. Target payout ratio 80%. EPS of current year 15. If I don't do all this Lintner, I will pay 15 into 0.8. I'll pay 15 into 0.8. How much I'll pay? 12. Increase should be 2. Actual increase is 2 into 40%. 2 into 40%. How much? 0.8. 10 plus 0.8 is the new dividend. 10 plus 0.8 is the new dividend per share. 10 plus 0.8 is the new dividend per share. This is the concept. 10 plus 0.8 is the new dividend per share. Able to understand this? Any doubts on the concept here? So I will pay a dividend of only 10.8. I'll pay a dividend of only 10.8. Clear? Any doubts on this? I've done. Is there a doubt? I've done few concepts. I'll quickly discuss the concept. First concept we learned is a share can be quoted at come dividend value and ex dividend value. Whenever it is come dividend, if you buy the share, you will also get the dividend income. Ex dividend, you will get only the share, not the income of that year. Next year and all you will get. Next year you will get. So if a share is quoted at come dividend, dividend will be paid, share price will fall, and then you will do reinvestment. So if they use the word declared, it means it is come dividend. Declared and paid, it means it is ex dividend. Declared and paid is ex dividend. Declared is come dividend. Declared and paid is ex dividend. Any doubts in this? Next concept we learnt is Graham and Dodd model. He said very simple, price is equal to what? Dividend plus 1/3 of earning into multiplier, not retained earnings, 1/3 of earning, 1/3 of earning into multiplier. Lintner said all other models are saying how much will be the impact on price. I am not bothered about price and all. I only want to play with the mentality of the or behavior of the shareholder. Shareholder don't like dividend going up, going down, going up, going down. They don't like it. So for them, what you need to do, first find out what was the last year dividend. Next, find out what is the ideal next year. What is ideal? EPS into payout ratio. EPS doubled, dividend will double according to the formula. Dividend will double according to the formula. Once you get the target amount, find out how much should be the increase. Actual increase is equal to target increase into speed of adjustment, or adjustment factor. Speed of adjustment or adjustment factor, and the actual dividend of next year is equal to last year dividend plus the actual increase in dividend per share. Actual increase in dividend per share. Actual increase in dividend per share. Any doubts till this? Understood the concept? Okay. One more thing I just want to quickly discuss and then I do question. You would have learnt about something called as buyback. Whenever a company does a buyback, the equity share capital will reduce and reserves and surplus will also reduce. What is buyback is? Buying back the own equity shares, buying back the own equity share. Let us assume face value 10 rupees, but buyback happens at 200 rupees. Buyback happens at 200. What is buyback is? The company is buying back its own share. When this happens, we will pass a journal entry called equity share capital 10. This is to cancel the share. This is to cancel the share into whatever number of share. Reserves and surplus. This will be reduced from reserve. Which reserve and all? General reserve, P and L, whatever the concept says. Okay, reserves and surplus will go down to bank account 200. To bank account 200. Whenever a buyback happens, you will see equity share capital going down, reserves and surplus going down, equity share capital going down, reserves and surplus going down to bank account, equity share capital going down, reserves and surplus going down. We learnt a formula called book value per share. Not sure you'll remember this. Tell me, what is the formula for book value per share? Share capital plus reserves minus fictitious asset. If you do buyback minus shares bought back, and here buyback size will reduce in the numerator. What is buyback sizes? 10 rupees will be reduced from share capital, 190 will be reduced from reserves, 200 you have to reduce. If you are doing buyback of 1 lakh share, you have to do 200 into 1 lakh reduction in the numerator and 1 lakh reduction in the denominator. 1 lakh reduction in the denominator. So a question may ask you, impact of buyback on BBPS. BBPS. What is the formula? Existing net worth. What is existing net worth? Share capital plus reserves and surplus minus fictitious asset minus buyback size is 1 lakh into 200, let's assume. In the denominator, 10 lakh shares minus 1 lakh. In the denominator, existing shares minus the shares bought back. Minus the shares bought back. Able to first understand the concept? I'll repeat the concept. Book value per share is equal to what? Existing net worth minus the buyback size divided by existing shares minus the shares bought back. Shares bought back. Any doubts in this example? Today we have 10,000 shares having book value of how much? 200. So listen, 10,000 shares. Today net worth is 10,000 into 200. Today the net worth is 10,000 into 200. How is 200 calculated? 200 is equal to net worth divided by 10,000. 200 is equal to net worth divided by 10,000. 10,000 goes to the other side. You get the net worth. You get the net worth. Company plans to buy back how many shares? 2,000. At what price are you paying? So 2,000 into 250, and in denominator you will subtract only 2,000. Book value per share will go down. See, you are paying 200 rupees share, 250 means other guys will suffer. What is the book value you get? 187.5. I'll repeat the concept again. Listen, book value per share is equal to share capital plus reserves minus fictitious asset by number of share. Question said 200 net worth by 10,000. 10,000 into 200 will give you the net worth. 10,000 into 200 will give you the net worth. 10,000 into 200, which is what? The net worth will be 10,000 into 200. This net worth will go down. Will go down when you do a buyback. How many shares we are buying back? 2,000. This will be the new net worth. Denominator to calculate BVPS will be 10,000 minus 2,000. Any doubts on the concept? I'll repeat the concept again one more time. First concept we learned today. Today was we started with a concept called cum dividend value and participate. Cum dividend value and ex dividend value. Declared a dividend. Declared a dividend. Share will quote at what price? Cum dividend. Then after payment it will fall. After payment it will fall. Declared and paid means it will quote at what? Ex dividend. Ex dividend. Practical world, it is not declared and paid. Declared after one specific date is there. They'll decide one date. Maybe you would have learnt in law. Declaration will happen after one specific date. You will reach the ex dividend date. You will reach the ex dividend date. After that, in few days, dividend will be paid. In few days, dividend will be paid. But for our analysis, declared means it is at cum dividend. Declared and paid means it is at ex dividend. With this, what will happen? You will have reinvestment. So cum dividend, payment, ex dividend, reinvestment. Cum dividend, payment, ex dividend and reinvestment. Cum dividend, payment, ex dividend and reinvestment. This is first part. This is the first concept we learned today. Then we learned Graham and Dodd model, which said that value of a share is equal to what? Dividend plus earning by 3 into multiplier. Dividend plus earning by 3 into multiplier. Then we had a model called Lintner's model, which said, Lintner's model said what? Nothing to look at the screen. Lintner's model said, first thing what you calculate? Last year dividend. Next is ideal next year dividend is EPS into payout ratio. Then the next is target increase in dividend per share. Next is actual increase is equal to target into speed of adjustment or adjustment factor. And the last point is next year dividend is equal to last year dividend plus the actual increase. Last concept, if you do a buyback, what is going to happen is the net worth will go down by the amount of buyback size. What is net worth? Number share capital plus reserves minus fictitious asset are number of shares into existing BVPS. Number of shares into existing BVPS. Number of shares into existing BVPS minus shares bought back into buyback price divided by existing shares minus the shares bought back. Existing shares and shares bought back. With this, the concept is over. One concept alone is pending. Any doubts till this? Clear? Can we proceed? Understood? Last model is called approach, Modigliani Miller approach. He basically said that whether you pay dividends or you don't pay dividends, it doesn't matter. Whether you pay dividends or don't pay dividends doesn't matter. Same thing is said in capital structure also. Whether you have 50-50 combo, 40-60 combo, 100-0 combo, 80-20 combo, doesn't really matter. Value of the firm will remain same. Now for this he gave his own logic. Let us understand this with an example. Okay. Particulars, dividend paid, dividend not paid. There is one company, that company may either pay dividends or may not pay dividends. He said that it doesn't really matter. It doesn't really matter. He gave his own logic. Let's understand this as we proceed. Let's understand opening share prices 200, 200. Dividend per share 20 rupees nil. Not paid means you're not paying dividend, and paid means whatever is the amount. 20 rupees, let's not 20, let me make it 10 rupees. Okay. Dividend paid is 10 rupees. Cost of equity 12%, 12%. Okay. Cost of equity is 12 and 12. Existing shares 1 lakh. Existing shares are 1 lakh. Total earnings, earnings means profit which the company is making. Total earnings is both the scenario same number, 20 lakh is the earning. I may change the number if needed later. Okay. And I also want to do some investment. Investment is going to be, later change the numbers if needed. Okay. This is the broad scenario. Okay. It is the same company. Okay. Opening prices 200, 200. Cost of equity is 12 and 12. Shares are 1 lakh, 1 lakh. Earnings is 20, 20. Investment is 40, 40. Only changes 10 rupee dividend, nil dividend. 10 rupee dividend and nil dividend. Okay. First thing he said is closing price. Closing prices. When I invest in this company, I will buy it at 200. I'll buy it at 200. What is the cost of equity given? Cost of equity is my required return. As an investor, I want a return of how much? 12%. So by the end of the year, 200 should at least become 224. At least become 224. But only thing is, this 224 can come in two forms to me. I want 224. How can it be 224? Dividend 5 rupees, price 219 rupees. Dividend 10 rupees, price 214 rupees. Dividend 20 rupees, price 204. Say, I want 224 at the end of the year. What form? I am not bothered. So he said price has to be 224. In this case, it will be 224 minus 10, 214. Minus 10, how much? 214. You are the shareholder. You are getting 214 rupees on the share and 10 rupees and 10 rupees in the form of dividend. Other side, it is 224 minus 0, 24. 224 minus 0, 224. The closing share price, one situation will be 214, another situation will be 224. This is point number one. Closing share prices 214 and 224. What is the logic for 214? 200 increase by 12%. What is the logic for 224? 200 increase by 12%. Deduct if dividend any paid. Deduct if any dividend you receive in between. And this you can also understand as cum dividend and ex dividend logic. Cum dividend and ex dividend logic. Ex dividend means post the dividend. Post the dividend. Okay. Now retained earnings. What is retained earnings is we earned 20 lakh. We earned 20 lakh. We earned 20 lakh. In this, how much dividend did we pay? 1 lakh into 10. 1 lakh into 10. I am retaining only 10 lakh. In this case, I am retaining entire. Okay, understood? How much investment we are making? We said some number 40 and 40. So what Modiglani Miller said is, if you pay dividend, you retain less. One hand I pay. Next hand I will say I need more money because I want to make investment. So fresh issue of shares. Fresh issue of shares. What is fresh issue of shares is, I want 40 lakh. In that 10 lakh only is available as retained earnings. 10 lakh only is available. Balance 30 lakh will have to come from where? Fresh issue of equity share. Fresh issue of equity shares. I will raise how much money? 30 lakh. Other side, what will be the fresh issue? 40 lakh minus 20 lakh. What we have done here is, what MM is saying, you paid 10 lakh, collecting back 30 lakh. You paid 10 lakh, assuming same shareholders, okay? Assuming shareholder, I paid 10 lakh. And after some time, I say, give me back 30 lakh. Give me back 30 lakh. Other side, I paid nothing. Give me back 20 lakh. Give me back 20 lakh. Give me back 20 lakh. Number of shares issued. Number of shares issued is 30 lakh divided by 214. Divided by 214. At the end of the year, I'll do this. 30 lakh divided by 214. 30 lakh divided by how much? 214. Can you tell me the number? Yeah, yeah. 01 point how much? Okay, 8.64. 20 lakh divided by 224. 8929. Okay, 8929. Number of shares issued. Closing shares. What is closing shares? Opening shares plus extra shares we are issuing for investment purpose. Pay dividend, issue more shares. Don't pay dividend, issue less shares. So closing shares is 1 lakh plus 14,019, 114,019, 114,019. This side 1 lakh 8929, 108 929, 108 929. Closing price 214,224. Can you multiply both? 114 in, I'll explain again. 24 lakh. Okay, sorry, 2 crore 44 lakh. Ignore that 66. Okay, ignore that 66. That's a rounding off difference. 2 crore 44 lakhs 90. Ignore that 96. Okay, rounding off. You did the round off. So what he said is, whether you pay dividend, you don't pay dividend, value is anyway going to remain same. Whether you pay dividend or you don't pay dividend, value is going to remain same. Value is going to remain same. I'll repeat again. We had a opening share price. We had a opening share price 1000. Opening share price 1000. Cost of equity 10%. Cost of equity is 10. Not cost of dividend per share 50 0. 50 0. Cost of equity is 10% and 10%. Existing shares 50,000. 50,000. Total earning is 50 lakh. Total earnings is 50 lakh. Investment is 80 lakh. Investment is 80 lakh. Closing price is my opening price into 1.1, 10% into 1.1. But if there is any dividend, if there is any dividend, if there is any dividend, you can deduct it. If there is any dividend, you can deduct it. How much is the dividend here? 50. Once you deduct, how much you get? Please keep participating. 1000 into 1.1. 100. Retained earnings is 50 lakh is there. From this 50 lakh, deduct the dividend paid. From this 50 lakh, deduct what? Dividend paid. How much is the dividend paid? 50,000 into 50. 50,000 into 50. How much value you are getting back? 25 lakh. Other side, entire 50 lakh. Entire 50 lakh. Clear? Any doubts on this? If 25 and 50 is retained, investment is how much? 80 lakh and 80 lakh. Balance money is fresh issue. Balance money is fresh issue. This fresh issue is 80 lakh minus 25 lakh. How much? 55 lakh. And this is 80 lakh minus 50 lakh. For this 55 lakh, I have to issue shares. For this 55 lakh, I have to issue shares. At what price will we issue the shares? 1050. Can you divide and tell me? 38. You round off the numbers, okay? And 30 lakh will be divided by what price? 1100. How much? 27. 2727. Closing shares is 50,000 plus extra how much? 5238, which is how much? 55 to 38. And this side 50,000 plus 2727. How much is this? 52,727. Closing price we calculated is 1050,100. Multiply both. Crore. 5 crore 79 lakh. Okay, 5 crore 80 lakh. Broadly 5 crore 80 lakh. 5.8 crores. Okay, 5.8 crores. 1050 into 55 to 38 is 5 crore 79 lakh 99,900, which is nothing but 5 crore 80 lakh. 5 crore 80 lakh. Other side, which is also 5 crore 80 lakh. The difference is rounding off. Okay, we will write the difference value, but that is rounding off. That is rounding off. Any doubts on the concept? Any doubts on the concept? Understood this? Clear? Just one more time. I'm taking some another number. 300, 500, 20, 0, 10%, 10%, 1 lakh, 1 lakh, 50 lakh, 50 lakh, 90 lakh, 90 lakh. Please fill this quickly. I'll wait for 4 minutes. Quickly fill this. If needed, I'll change the number. I don't see a need. You do it anyway. I'll do it in the screen. Understood? I gave 2 examples. Understood? Do it. Else, I'm going to do it in some 2 minutes. closing prices. I will start doing it now. You can keep doing it still. 500 into 1.1, and there will be a reduction of 20, which is 530. 500 into 1.1 minus 0 is 550. Retained earnings is 50 lakh minus 1 lakh into 20, 30 lakhs, and this side entire 50 lakhs. Fresh issue of shares is I need 90 lakh money. In the 30 lakh is available. 60 lakh divided by 530. 60 lakh divided by 530, and this side 40 lakh 550. 530 and 550. 530 when I divide, I get 11,321, and 40 lakh divided by 550 we get 7273. 7273. Number of okay, this is number of shares. This was the value. Value is 60 lakh, 40 lakh. Closing shares is 111321 and 107273. 107 and 273. Multiply with 530, 550. 11321 into 530 is 5 crore, 5.9 crores. 5.9 crores. Other side will also be 5.9 crore. You will write the proper number. I've just written 5 crore. You can write 5 crore 90 lakh 130 rounded off to 5 crore 90. Any doubts in this? This is what MM said. Whether you pay dividend, you don't pay dividend, how does it matter? How does it matter? First, any doubts till this? Now I show it on the screen. Step 1. Closing price. P naught into 1 plus KE minus D1. 1 plus KE minus D1. Retained earnings. Total earnings minus dividends paid. Money needed to be raised as equity. Investment minus retained earnings. Number of shares issued. Step 3 figure divided by step 1. Closing shares into closing price. Value will remain same. No impact on value of firm whether DPS is paid or not. Whether DPS is paid or not. One example is there. I don't want to do this example. We have done a lengthy explanation. Any doubts on the concept here? Understood? Done? Clear?